So, all right, everyone in the class, very good morning. People in the class, very good morning. Welcome to the session. Welcome to the fourth lecture of CA Final AFM, the ultimate power batch for Jan 26 and onward attempts. How are you all? Everyone. So, very happy Monday. Everyone in the class, how are you all? Who all do I have in this live class today? Come on, please tell me in the chat box. People. So Anuka is here, Srivastav is here, Akshay is here. Very good morning, guys. Who else? Live people, come on, are here. Please tell me. Come on. So all the recorded people, welcome to the session. I really wish we could have met live. We could have talked more. Because that's what I like the most. I literally like to talk to you people, simply. Who all do we have in the class today? Live people, please confirm. And also confirm if you can very clearly see me, hear me, what is the status. All good. So let's very quickly try to revise the things that we had done in the class, in the previous class actually. What we learned. Sir, so one second before we proceed. How many of you have become people in the class in the flow of watching the lectures, in the flow of revising the things at home, or maybe solving the practical question by writing them down in the notebook? How many of you are there in that flow? Come on. This very importantly needed communication, I need to do it in the class right now. Please, everyone. Come on. You all respond, then only I proceed. I am not saying why are you not doing revision or whatever. I'm just asking you, have you been doing the revisions at home along with the lectures? Because you won't realize with every day passing by, the topic will get over, then the chapter will get over, then some portion of your subject will get over. You won't realize that if we don't revise on a real-time basis, then we won't be able to get out the best results. Come on. Do you know the price that you're paying for the power batch is really high? How many of you realize it? Some might think, sir, it is just 2000 rupee or whatever amount you have paid. I don't know, 1500, 2000, 2500. You feel that, sir, it's a nominal amount relative to any other batch that you purchase. That's true. When it comes to money, the amount that you pay is relatively very low. But you know the most important thing? Out here in this power batch, most of the student would do this batch in the last 6 months of their exam. Most of them. Maybe some of you do it in the last 1 year of your exam. But if you do it in the last one of your exam, you have to please realize you are putting in one of the most precious thing that you have in that time period, which is the time. Money, what you are paying may be limited, but the time that you are paying, the efforts that you are making is far more worthful, is very costly if you realize that you pay. 4 months are left to the exam, 3 months are left to the exam, and at this point if you are made to pay 75 something hour for a batch, then that's really a very expensive batch. So when you are spending that amount of time and efforts, make sure that you get the best out of it, which will happen when you revise the things at home. And that will anyways be counted as your first revision, right? I'm not asking you to do anything extra in the batch. That will anyways be counted as your first revision. So recorded people, live people. If you are aligned to the target of 80 plus, then the efforts to be made in this batch has to be at a different level. Am I, people in the class, very clear to all the students about it? Super ultra fast, give me a response, then we proceed ahead. Come on. I'll share my screen in the meantime. Give me a minute. By the way, are you people able to recognize to me with small hairs? Come on, live people sitting in the class, do talk, do respond, otherwise what is the point of sitting live? Come on. Who all do I have in the class? Please respond. Anuka, you're not here. Shivastav, not here. Aksa, here or not? Oh my God. 1 second. Shivastav, do respond now. Great. So now let us very quickly proceed. Sir, what we had learned in the last lecture was cash flow based valuation. To give you a super quick brief, although we don't deserve to revise in this small duration power batch, that become your responsibility as I just spoke. But yeah, for now, just for your ease, I'm repeating the things. Sir, when it comes to cash flow based valuation model, the value of a company is the present value of future cash flows. Which all future cash flows? Sir, future cash flows called as FCFE, FCFF. If I talk about the cash flows that belong to all the capital provider, that is FCFF. If I talk about cash flow which belong to only equity, then we call it FCFE. So PV of FCFF and FCFE will be the respective value. Means PV of FCFF will be called as value of firm. PV of FCFE will be value of equity. To discount FCFF, we use KO. To discount FCFE, we use KE. Then sir, when it comes to discounting, you have to realize it is one of the three models. When the cash flows are constant, do you remember the question that we did in the last class, that incremental value due to strategy? There was a sales strategy for 3 years or 4 years something, where my PAT, an amount of 1400 was constant forever. This is the formula we had used, correct? Constant cash flow forever. This is constantly growing cash flow forever, calling it to be the Gordon's model, and this is variably growing cash flows. That's how you calculate the value of equity of firm. Now when it comes to FCFE, FCFF calculation, it's really simple. Think of the cash flow statement. Start with the profit which belongs to firm, start with the profit which belongs to equity. PAT or no PAT. From PAT to the PAT, you add back depreciation, deduct working capital, deduct capex, add back depreciation, deduct working capital, deduct capex. The only point of difference is that when it comes to FCFE, even debt related payments are to be adjusted. Come on, all the live and recorded people in the class, please in the chat box try to identify all those payments and receipts that relate to debt, which are from the debt or which are to the debt. Come on. I'm expecting you all to respond to this question in the chat box. Come on. Let's figure out if you are able to think along with me or not. Apply your common sense. Dig down in your knowledge bank. What are the payments or receipts which relate to debt in my business? So Aksa says, sir, it is interest. All right, fine, great, brilliant. What next? Come on. What else? Other life, people in the class, what else? Please tell me. Is that all? Recorded people, could you think of such cash flows? Sir, first cash flow to the debt is the payment of interest. Let me tell you, if you don't participate, you don't experience what you're here for, that live experience. You don't evolve as much as you're supposed to evolve, right? So any which ways the choice is yours. What I'm saying is that, sir, first we make the interest payment to the debt, then we make the principal repayment, and sometimes we borrow from debt. These are the three primary cash flows. If you realize in the calculation of PAT, interest payment has already been deducted, correct? When it comes to repayment and borrowing from the debt to the debt, right? So these are another two cash flows. So all the cash flows have been considered. Sir, in the AFM, you would never see preference share, which is why I have not specifically talked to you about preference dividend being deducted or preference share capital being paid out. However, if there is, you all should deduct it. That was the discussion of the concepts that we had made in the last class. Now I take you to the next concept, which is asset-based valuation model. Yes, all the live people, all the recorded people, shall we proceed ahead to learn the new things? As the name itself would say, this valuation model considers asset as the basis of valuation. Previous model, the first model considered dividend as the basis, the second model considered cash flow as the basis. This particular model makes asset as the basis of deciding the value of the company. Even if I don't teach to you anything, if I give you the balance sheet where the assets and liabilities are, ask you to calculate the value of the company from that balance sheet, please tell me, think in your brains what every single student would do. Right from the student who are in CA enter till the CA finalist, everyone will imagine the same thing, that as per balance sheet, the value of the company is what? All the assets minus the liability will be the leftover value, the claim of equity shareholder. Do you agree? That is how simple it is. Sir, we say we take the value of the assets of the company, all the assets, right? Sir, that value is done. Minus the value of outside liabilities, because on those assets, the first claim is of the outside liability, right? Minus the value of preference shareholder claim, which means if there is a preference share capital, then they have a priority over and above equity. They have a preference over and above equity, correct? Then whatever is left is the value of equity. Now the important things to understand. Sir, when it comes to the value of asset, which value do I have to take, sir? Do I have to take market value or the book value or any other value? Sir, that depends on the model to be followed. Three easy models are covered in the single model. First, net asset value model. Second, net realizable value model. Third, replaceable value model. For example, when examiners say find the value of the company using net asset value model, then you have to use the market value of all the assets. That today if I go to the market, what is the value that this particular asset has? That is the market value of the asset. Second, sir, net realizable value, liquidation value or adjusted book value are the terminologies which all of them reflects the same thing. When I go to market to sell off these assets, what would I generate? Net realizable value from the asset, which is market value minus the selling cost. The concept you all really know. It really covered in FR. Yes. Liquidation, at the time of liquidation, generally this process gets applied because assets are sold only at the time of liquidation. Otherwise, why would I sell my ongoing business? The entire business is sold off only at the time of liquidation. So when examiners say NRV value, liquidation value, adjusted book value, you take NRV of all the assets. Last is replaceable value if institute asks, so you take the replacement cost of all the asset. So depending upon which specific model, that particular value of all the asset minus same value for the liabilities minus the preference shareholder claim will give me the total value of equity as per that particular model. Yes. Now this is the total value of all the equity shares. When I divide it by n, which is the number of share, I get per share value of equity share. That will be NAV per share, it may be replaceable value per share or any value per share is how this simple model is. Sir, what if institute does not specify which exact model? Institute give me the balance sheet, give me the asset liability, ask me to do the value of the company. Not even specifying asset based model. So looking at the balance sheet, there is only one thing which is possible, which is asset based model, and in the absence of any other information, NAV model is what you should follow. Because more than almost all the questions belong to this model, there is almost no question to the other two models. But as I say, we learn. What we learn is comprehensive. It is there in the study material, we learn it. Yes, people? It is there in the study material, we learn it. Yes. So, sir, if it is NAV model, what if the examiner does not give you market value? If it does, follow it. If it doesn't, consider the given book value as market value. And that's simple. The valuation as per asset based model is. I need a validation from every single student watching up this lecture. Please tell me, could you understand it entirely? If you understood, press like button. If you did not, say it in the chat box. I'll explain it again. Come on. Come on, come on, come on. All the live and recorded people. Speak up. Yes. Done. So great. Sir, let us very immediately look at a practical question of this type. 1 second. So by the way, these are your theory notes, which are there at the end of the out notes. Great. Question number 47. An easy question, extremely easy question in fact. Seems lengthy but is actually not. I'll very immediately summarize the information given in the question for you. Please listen to me carefully. There are two companies ABC, XYZ. Both the companies, the beta of both the companies is given to me. RM has been given to me. In your imagination, could you please connect to what is this information used for? So obviously, calculation of KE. Done, sir. What ahead? Growth rate of both the companies have been given 15 and 12%. Further, both the company follow constant dividend policy. Fine. CEO require information about how much premium above current market price to offer for XYZ's share. Sir, what is the story? ABC, my first company wants to acquire, take over second company XYZ. So ABC will be called as acquirer, XYZ will be called as target. Now imagine that you're a company I want to buy. Your per share value in the market right now is 500. Your shares are trading at a price of rupee 500. If I come to you saying that I want to buy your company for 500 rupees, will you be motivated to sell your entire company to me? You'll be like, sir, what is the point? When we can sell off the entire, when we can sell off our shares in the market, what is the point of selling to you for the same amount of rupee 500? So what would I have to offer to you? I will have to, people in the class, offer to you some extra amount over and above CMP. Our market price, yours is 500, I might offer to you 550. So that 50 rupee extra that I offer to you is called as premium above current market price, which is generally the case in case of mergers acquisitions. Please, everyone in the class, could I explain such simple thing? Right? Sir, two suggestions have been forwarded by the merchant bankers. Now, when we do this M&A deal, we have an investment banker who acts as an intermediary between the two parties. That investment banker, that merchant banker says, you have two options to value the company. Which company? XYZ. Why do you need to value? So that I can find out how much extra I'm paying over and above CMP. I can find out the people in the class. I can find out the premium. So. There were two options. One was the price based on XYZ's net worth as per balance sheet. Net worth as per balance sheet means net assets as per balance sheet after adjusting the current value of assets. In that balance sheet, whatever is the current value of assets that you adjust and estimated after tax profit for the next 5 years. I'm expecting you all to read this particular line again. Come on. Super ultra fast, people in the class, read this particular line again. Have you read? Sir, it says you have to value the company based on the net assets of the as per balance sheet. Fine. After adjusting first the current value of asset and second estimate profit after tax for the next 5 years. Sir, we understand that current value of the assets can be adjusted. What about the profit for the next 5 years? How do I adjust it? The question is not very clear. They mean to say after adding the profit for the next 5 years. Which means, sir, what is the logic behind this method? No logic. I am the acquirer, you are a target. When we negotiate, we have come across a conclusion. We have come across a method that this is how we value your company. This is the method we have made, you and me. If both of us are okay, who the hell anyone else is to figure out whether this method is logical or not? Are you understanding? Fine. Sir, another choice is to value the company using dividend valuation. This is the balance sheet of the company. The balance sheet had one problem. The problem was that long-term loans, which are there as a part of the asset, is actually supposed to be there as a part of the liability. That's a misprint. Which is why right now, if you look at the balance sheet, if it won't match. However, when you bring it here towards the liability, it will match. I'm expecting that if the question comes to exam, it should come to you in a rectified form. However, if you are able to recollect it, that okay, there was this asset-based valuation question, then just do total the balance sheet once. Yes, but mostly it'll come to you in a rectified form, so don't worry at all. Then we also have the income statement. They say net profit of the company is 7,002,250, from which interest tax is deducted these amounts. So what they are left with is distributable profit. Sir, if the interest tax is deducted after it, then it obviously is not net profit. This is my EBIT. The terminology which they have written is incorrect. This is actually EBIT. Now this amount is net profit, and from this net profit, if the dividend is distributed, whatever left is the retained earnings. Done. Additional information: ABC's land building recently valued. My acquirer company's land building of 5600 was recently valued. XYZ has not been revalued for 4 years, and during this period, average value of land building increased by 25% per annum. All the live people in the class, recorded people, please listen to me. The land building of this company has not been valued for the last 4 years, right? So on an average, there has been 25% increase every year in the value of this particular asset. Face value of the companies has been 10 and 25 rupees. Market price share of the company 310, 470. Right, we are required to calculate premium. So first of all, we have to. Did you observe this self note? As I said, I have tried to make these out notes as self-explanatory as possible. Frankly. Right, so this is how it is, this is what it is, the self note. Sir, let's first try to take all the assets of the company minus the outside liabilities, assets based on the current market prices, liability you deduct, add the profit of the next 5 years, and you are done. Sir, assets, except for land building, all the assets are to be considered at book value. Land building 1500 is the price 4 years back. For 4 years, 25% per annum value increases how much? So there is this small mistake that a student might end up making. You might ignore to give the effect of compounding to this 25% increase. Someone might think that okay, 25% per annum increase, so for 4 years it is 100% increase. No. It has to be with the effect of compounding, that of every year it increased by 20%. So if it is how much right now? If it is 1500 right now, then 1.25, which is 1 plus 25% to the power 4 will be the correct value. 1.25 into equal to multiplied by 1500 is 3662.109, which is 11. Plant machinery, receivables, stock, bank cash, other assets as it is. No point of calculation needed here. Now, from that you deduct the outside liabilities. Term loan, you realize what was the problem. Other liabilities, you deduct creditors, you deduct bank OD, you deduct tax payable. In fact, let me tell you, the dividend payable of the company is also a liability when it comes to share valuation. Correct? Dividend payable is also deducted. Those who didn't have this clarity, please remember. After considering all the assets and deducting all the liabilities, what I am left with the total net asset value of the company being 8362.11. At this step, I would wait for everyone to respond. Are you all 10 on 10 aligned? People in the class, please tell me. Waiting for y'all. Process what is going on, please. Yes. Come on, people. Yes, aligned are we? Shall we proceed? So, sir, now I have to take the profit for the next 5 years. Which profit? Profit after tax. So for this company XYZ, how much is the PAT? Sir, PAT has been 1510. This was the PAT of 0 year. This PAT is expected to grow at the rate of 12% for the next 5 years. So let me grow the PAT by 12%. So 1 5. How much was it at 0 year? 1510 plus 12% is 1691.2 plus 12% is 1894.14. That's how I add the profit for the next 5 years, the grown up profit of next 5 years. So what was the value of the assets company? The NAV after adjusting the current value of the assets and the NAV after adjusting the profit for the next 5 years. Sir, how much is the total value? Sir, profit for the next 5 years in the value of asset 8362.11 plus 1691 plus 10743.94. It gives me 19106.05. This is the total value that we are ready to pay for how many number of shares? Sir, share capital is 1000, where per share value is 25. So 1000, everything is in lakhs. 1000 divided by 25 give me 40 lakh shares. This many lakhs total value of the company divided by 40 lakh shares. So 19106.05 divided by 40 lakhs give me 477.65 as the value per share. Yes. Sir, institute is not asking for the value, it is asking for the premium. How much extra are you paying? Sir, the value that we are paying is 477, where price of the company in the market is 470. If you deduct a 470 from it, it is 7.65 rupee that I pay extra, which is premium over CMP. Or in percentage terms, can I say 7.75 I'm paying to you extra over a price of 470? So divided by 470 in percentage terms is 1.627, which is 1.63%. People, please tell me how much out of 10 are you people settled with this? Settled. Easy question. Ask for the valuation. So what has this particular question taught to you? As I tell you, you don't have to learn a question. You will have to learn rather what all has the question taught to you. At any point in any other question, now if institute asks you to calculate the premium over CMP, would you be able to relate the context of it? First. Second, sir, if by chance institute give you in the exam any other question where it does ask to you the net value of the asset after adjusting some kind of profit, will you be able to recollect that adjusting the profit means adding up the profit to this particular value? This is what this particular question has taught to us. Am I making sense? Please. Come on. Sir, this was question number 47, part A. Part B, which is dividend based valuation model, is extremely easy. You'll have to do it at your own. Dividend is there, growth is there, K is there. What else is left for the dividend valuation? Nothing. Sir, where is dividend? This is here. 760 total dividend paid on 40 lakh share. How much is the per share dividend? This is what you see here. Yes. So this was question number 47. 48 is similar nature question that institute asked. This question everyone will be homework, but I teach to you the point of difference between this question and that particular question. Right? Give me a minute. Let me have water, please give me a minute. Yes, people. Dhananjay, what, where have you been? Anuka, I really appreciate. Anuka said, sir, whenever we were compiling all the things that we have learned, we also learned one particular thing. What is that? The fact that, sir, whenever institute asks us to revalue the things, we have to increase the value of asset on a compounded basis. 1 second. Huh? Come on. So, people, we go ahead to the next question 48. Sir, 48 question, let me tell you the things that institute has been doing for years, which it very intensely did in which year? In November 24. Institute will give you a question in the exam which you will think that, okay, I've seen such similar question in the study material. In fact, it was there in Sir's outscanner. But you know what does institute do? The question which a study material or the outscanner has some information given, then it asked a particular part, it asked a particular thing in the requirement. In the exam, it will give you a similar looking question, but whatever was asked here is given here, and whatever was given here is asked here. So the point is, institute make you do the reverse calculation, etc. stuff, even in the exam directly when you feel that, okay, I've seen such question. Which brings me to tell you a very important thing. In the exam, whenever you read the question paper, you should very strictly read the required part of the question. That generally, if it is if it is the question of valuation, where the cash flows, etc. things have been given, shouldn't the required part be find the value of the company? Or the required part be find this? Something which is natural. It should generally never happen otherwise that calculate the KE of the company where the value has already been given to you. So we have to always read the required part of the question very importantly whenever we are reading the question. Right. Question 48, similar nature question, certain things are different. For example, in this question, if you observe, RM, RF, etc. things are not given to you. Then, sir, how can I find the value of the company if RM, RF is not given, because I won't have KE? Can you please help me recollect what was the second thing? After the CAPM, the second thing was Gordon's model to calculate KE. So then you will have to make use of Gordon's model, figure out if the data which is given in the question is sufficient or not, and you will have to solve it. Now, a very important thing, read this line. We have to again calculate premium, right? This question is homework, but I am trying to teach you the point of difference. We have to again calculate premium, but this time the net worth of the company, the net worth adjusted for current value of land buildings are similar to the previous one, plus the estimated average profit after tax for the next 5 years. Sir, I have to teach to you two particular things. Out there in the previous question, they didn't use this word plus. They used this word called as adjust. After adjusting the profit for the next 5 years. Out here they have used the word plus, which makes the life of a student easy. We know that we have to add it. But very importantly, the point where most of the students made this mistake is this word average. The students, so that we have already done this question, and out here in this particular question, we saw that average word was nowhere specified. Estimated after tax profit for the next 5 years has been specified, where in the exam suddenly it inserted a word called as average, which means you have to first calculate the profit for the next 5 years divided by 5 to find out the average profit and then add it. Sir, I agree to your things that, sir, is extremely difficult to take care of such small things, agreed. But if we don't try, it is not just difficult, it is impossible. At least by trying for it, can we be consciously, cautiously aware, be aware of such things, right? And never make those mistakes. Yes? So that's how and that's what it is. This particular question 48 is homework. Now I very immediately take you to the next model, which I am wondering if is of priority or not actually. Cool, let's do it. Let's not ignore it. If not all the questions, but at least some question we do it so that you get a sense of what it is. So next model is earnings based valuation model. This time we will consider earnings of the company as the basis of valuation. Not cash flow, not assets, but the profit that company makes as the basis of valuation. Sir, first is earnings capitalization method. So the logic to this method is really simple. How many of you remember earnings yield formula? Come on. I'm expecting this to be answered by all the students. All the live people, all the recorded people, in your brains at least, what was the formula of earnings yield? People. Sir, you told us that whenever the word yield is there, it means a return based on MPS. Dividend yield was DPS divided by MPS. Earnings yield is EPS divided by MPS. So can I say it otherwise that MPS of the company according to that will be EPS divided by earnings yield? So if I have the earnings of the company, I'm trying to find the MPS, I'm trying to find the value of the company using its earning. So if I have the earnings of the company, if I have the earnings yield, can I capitalize that earning? Capitalizing means converting a profit number into a value number. Our EPS number is a profit number. When you divide it with the rate, it becomes a value number. Are you please aligned to it? Yes. Which means, sir, in this case, first of all, we should learn to calculate EPS. Then we should know what will be used as earnings yield. And then the value so arrived should be clear as what value. These are small things you have to understand, starting with the earnings. What in our common sense is earnings is officially called as future maintainable profit for this method. As I said, every acronym will be presented in this blue color. Future maintainable profit. In simple words, we want to calculate the profit after tax that company will be able to maintain in future. The past profit doesn't matter. When you invest in the company today, the profit that you'll make in future matters. So we start with the reported PBT, that in the past, as in the last year, how much profit before tax was reported. Sir, what if the PAT is given? Convert it to PBT. Then we say, in this reported PBT, was there a loss which was extraordinary in nature, exceptional in nature? If there was, let's eliminate its effect. Because it was exceptional, it won't happen in future. So let us add back to find out the future maintainable profit. Similarly, if there was any extraordinary income which won't happen in future, let's deduct that extraordinary gain or income and eliminate its effect. Now, this is the profit where all the previous exceptional items have been reversed. What if I am starting with something new which will give me future extra income, future extra expenses? So we say if there are any additional future income, you add it. If there is an additional future expense, you deduct it. Give the effect of those income and expenses. And then I get the profit which will be maintainable, which I'll be able to maintain in future. This is my PBT. Because I started with PBT, I stand at PBT. In the future, there would be some tax rate. If you deduct, I get is future maintainable PAT, which we officially called as FMP. So when it comes to capitalizing the earnings, first of all, we should be clear that what earnings do we capitalize. Sir, it is the FMP of the company that we capitalize. It is equivalent to that EPS which I was explaining, sir, divided by the capitalization rate. Now there is a small ambiguity in the concept given by institute, but I would say we won't have to worry about it. Why? Because this thing is already rare to worry about. So you can chill out, no worries. Sir, please understand what I'm saying. Let me tell you. Sir, to the FMP, you divide by a rate. Sir, what is that rate? That rate which institute might give to you in the form of capitalization rate or discounting rate or KO or KE, or it may give you earnings yield. Any of these combination is possible. In fact, if you are able to recollect, earnings yield was also 1 divided by P. Institute might give you P is the formula to calculate the value of business, which means the value so arrived will be the value of not just equity, but will be the value of equity plus debt, calling it to be the value of entire business. Everyone in the class, the most important line you had to understand. You may find it illogical that, sir, in the numerator you have taken the PAT, which belongs only to equity, because while calculating PAT, the interest has already been deducted. So if you take a number in the numerator which belongs only to equity, how can it arrive at a value which belongs to both of them, equity and debt? Sir, this is what I'm saying. This concept has ambiguity. But from exam point of view, since there is already a very rare possibility of being asked, we don't have scope of first learning what is logical and then learning what is needed for marks. Yes? Sir, what is the conclusion then? Let me explain. Forget what the numerator is. It is PAT or whatever. In the denominator, if the rate is KO, if the discounting rate is KO, which belongs to everyone, we assume the value so arrived will belong to everyone. It will be the value of business. However, if the discounting rate is KE, which belongs only to equity, then we assume that the value so arrived, people in the class, the value so arrived will be, people what? Value of equity. So discounting rate will decide whose value is being calculated, ignoring the fact what is in the numerator. If it is value of business, deduct the value of debt and preference share from it, then what will be left is the value of equity. As per which model? Earnings capitalized value model. Dividing it by number of share will give you the value per share. I've explained to you the three things. Calculating FMP, the rate to be used to discount the FMP, to capitalize the FM to calculate value of business, and the value so arrived, the understanding of whether it is equity, business, and if it is business, how do you calculate equity, and so on. Earnings capitalization model, everyone in the class, super ultra fast. Please validate if you're settled or not. Come on, waiting people for your responses. All the live and recorded people, please tell me. All set, all clear. Do you have some background noise? Give me a minute, let me clear it up for you. One second. So what is actually happening is some construction is going on. The backside of my house. There's some other house getting constructed. So alright, fine. And cool. So people, earnings capitalization method we are clear with, and now we go to the practical question based on this method. So 49th question is good enough. Then. So see, what is the plan? 49th, an easy question, you will have to do it at your own. 49th question you have to do at your own. You may do it on Calci. Only Calci solution is also okay. 49th. But it is ambiguous. Has some ambiguity. Sir, what is the ambiguity? When you read it at your own, you will know what the ambiguity is. Fine, first thing. Then is 50th question, easy, very easy. The main question that we want to do in the class is 51. Cool. So let's do this particular question, 51st in the class right now. The closing price of LX is rupee 24 per share on 31st March 2019. There's this company called as LX Limited whose share price is rupee 24 on 31st March 2019. The P ratio was 6. It was found that amount of 24 lakhs as income and an extraordinary loss of 9 lakhs were included in the books of accounts. Please read this particular line. What they try to say is that when we looked at the books of accounts of the company, when we looked at the income statement of the company, sir, rupee 24 lakhs as income and 9 lakhs as loss were included in the books of accounts. Sir, institute missed to add the word extraordinary here. Ideally, only when an income is extraordinary, you eliminate it. But institute missed to add this word. Sir, what it meant to say is extraordinary income and losses have been also included in the income statement. The existing operation except for the extraordinary item are expected to continue in future. Excluding this extraordinary, everything continue. Company has launched a new product with the following expectation. New product will have sales this, cost as this. Company has 5 lakh equity share of 10 each. 1 lakh 9% preference share of 100 each. P ratio is 6 times. Post-tax cost of capital 10%. Tax rate 34%. People, you are required to determine existing profit from old operation, which means existing profit after tax from old operation. Given the challenge in the class, how many of you think that given the data in the question, somehow we can calculate the PAT? Literal classwork challenge to everyone. Literal classwork challenge. People, how many of you think? No hurry, take 30 seconds, 1 minute, solve it. But if you try, you evolve, and that's why you are here. Come on, everyone. Could you think of it, people? Sir, I need to calculate PAT. Think. Let me try to teach to you how do you think. I mean, that's very, if you realize, rare if someone teaches to you how do you think. Generally, when I think about PAT, what is the way? I've been given the sales. From the sales, I deduct expenses, I get EBIT, interest, tax, everything I deduct, I get PAT. But obviously, looking at the question, you realize that I have not been given the sales and everything. I have not been given that. Then how do I calculate PAT? Though let me think, is there any scope or possibility of reverse calculation? For example, when I look at it, everyone in the class, when I look at it, I see that I have been given the price of the company. I have been given the P ratio. Then this extraordinary income and expenses. So the extraordinary have already been included in the PAT, so I don't have to focus on them. Because I anyways need to calculate PAT. And those extraordinary are already included. Fine. Now this is the details of new product that is yet to start, and what they want is the old operation, which means this can be ignored. Then this is my capital structure. Then how do I calculate PAT? Again, let me think of the information given. Sir, if I have the closing price and if I have the P ratio, can anyone in the class think if the P ratio and the price are related to each other? Obviously, yes. Sir, the formula of P ratio itself is EPS divided by MPS. So if I have been given MPS as 24 and P ratio as 6, won't we be able to get EPS of the company? Yes, sir, it will be ₹4 per share. How many such shares do I have? 5 lakh. So, sir, if I have the EPS of 4 having 5 lakh share, I get the EAES. People, per share EPS is 4 if I have 5 lakh such share. So, earnings available to equity shareholder is 5 lakh into 4, which is 20 lakhs. Sir, this time I also have the preference share capital, which means I must have distributed the preference dividend. On 100 rupee, if it is 9% of dividend rate, then it is ₹9 per preference share dividend. Multiplied by 1 lakh share give me 9 lakh shares of 9 lakh rupees of preference dividend. So EAES comes after deducting preference of 9 lakh. So PAT minus preference is EAES of 20. Then how much would the PAT be? Sir, 20 plus 9 is equal to 29 lakhs being the amount of PAT. Super ultra fast validation of all the live and recorded people in the class. Are we all please 10 on 10 set? Come on. Come on. Are we all please really 10 on 10 set? What do you all say? Yes, perfect. Sir, the next thing they ask us to calculate the value of the business. Sir, value of the business using which method? Have they specified? But given the information, given the extraordinary things, additional income expenses have been given, obviously you won't apply dividend or cash flow or asset based valuation model. It is earnings based valuation model, right? So I have the PAT already reported by the company, 29 lakhs. What I need is the PBT, because from the PBT I need to eliminate other income and expenses. Sir, if the tax rate is 34%, then PAT would be 100 minus 34, which is 66%. Then can I say 29 lakhs is equal to 66%, which is after deducting 34%? Then how much would the 100% be? Basically what I'm trying is to convert my PAT to PBT. What is the general logic? Sir, PBT into 1 minus tax rate is equal to PAT. 29 lakhs of PAT available divided by this number of 66% will give me PBT. 29 divided by 66% is 43 lakhs 93,939 PBT, in which I know this extraordinary income of 20 lakhs included. I need to deduct it. Loss already deducted, I need to add it back. 24 or minus 9, 24 lakhs I minus 9 I add. Then From this new product, how much is the profit? Sir, 150 revenue minus 40 cost minus 34 cost minus 24 cost. 52 people is the profit from the new product. So 52 plus 28, 90. In fact, this you eliminate. This is of no use. 43 minus 24 plus 9 plus 52. So 43, 93, 939. 43, 93. 930, 43, 93, 939 minus 24 lakhs plus 9 lakhs plus 52 lakhs is 80 lakhs 93,939. 80 lakhs 93,939 is the PBT of future, from which if I deduct 34% tax rate, it is 53 lakhs 42,000, everyone in the class, as my future maintainable profit. I told you profit may be PAT. Profit is PAT. You don't have to look at the numerator. If the denominator is cost of capital, it is the value which will belong to the entire business. If 10% is the cost of capital divided by 10%, you get 5 crore 34 lakhs 20,000 as the value of business, which is what they have asked you. Easy basic question once you understand what it is. Yes. Similar to 51 is another question 52 that we're gonna cover right now, that we're gonna learn right now. Similar nature question. This time also they ask you to calculate, people. This time again they ask you to calculate the value of the business. So obviously I will need FMP and I will be able to calculate the value of the business. Sir, for FMP I need given reported PAT or PBT. So I have this time the reported PAT directly. In the previous question, what happened? From the market price, I did calculate the PAT. And using that PAT, I calculated the value of business. In this question, PAT has been given. I will be needed to directly calculate the value of the business in the first part. In the second part, using this PAT, I have to calculate the market price per share, which means I have to deduct the preference dividend. I have to make use of P ratio. So deducting preference dividend will give me EAS. Dividing it with the number of share will give me EPS. And EPS multiplied by P ratio will be MPS. So as I said, institute do try to ask the similar looking question but if reverse nature. Yes. So what are we gonna be doing now? Sir, using the PAT, first of all calculate the value of the business using FMP. Done. Sir, I have been given the PAT of 100.32. This is not I'm making you people solve it, just understand it. Sir, divided by 1 minus T, I'll get PBT. Extraordinary loss I deduct. Extraordinary in loss I add back, income I deduct. Then from the new operation, additional profit, what we had in the previous question as well, that we do, I get future maintainable PBT, I deduct the tax, I get future maintainable PAT. If I divide it by the capitalization rate, I get the value of business, which means this part is particularly 100% same. Value of business calculated here is same as the value of business calculated in the previous question. From PAT to the value of business. Only difference is out here I have the PAT directly given. In the previous question I had to first compute the PAT from the EPS or from the MPS. MPS divided by P was EPS, multiplied by number of share was EAS, adding back the preference dividend was PAT. Now in this question, second part is, listen to it carefully, determine the market price. Which means this time do you realize I have to calculate the market price. Now let me try and teach to you where I got confused as a student. What I thought was, I have the value of business already calculated. So what I thought was, From the value of the business, I deduct the preference claim, which means the value that belongs to preference share capital. Then rest of it will be the value of equity. Dividing it by the number of share will be the price value per share of equity. Are you understanding what I'm trying to say? I thought I have to find the price of equity using the value of the business that we calculated. That was what my thought as a student was. Could you please all understand what I'm trying to tell you? Come on, people, please tell me. Am I making sense? But what we had to actually do is to kind of remember it, that we have to calculate not the value but the price. Value means, everyone in the class, value means what according to our calculation the value is. Price means what it prevails in the market. The price which prevails in the market, people, that is different thing. However, this logic that I'm trying to give to you is not 100% correct, because institute interchangeably uses the word price and value. So this is a kind of remembrance you will have to have. So two things to remember. First, that we don't have to calculate the price using this value. Rather, we have to calculate the price using its profit. That okay, this is the profit if given, then let me do the calculation of EPS and P and find out the MPS. But unfortunately, there is one more problem. Yeah. So, there is one more problem. What is the problem? The problem is that rather than are you people having background noise? People, please tell me, are you having some background noise or someone saying something? Not the hammering sound, that I can't control. I can control the noise of people speaking. Was there any? There is, right? Give me a minute. So okay, let's proceed right now to learn the things ahead. In the break I'll do it. We'll take a very small 2-3-5 minutes break today. Just that's one. So the problem is, institute we thought will take a reported PAT, because from the PAT which was there, if I deduct the preference dividend, if I deduct the preference dividend, then I have the earnings which are available to equity shareholder. If I divide that by the number of share, I have the EPS, and to that EPS if I multiply the P ratio, I have MPS. That is what I want, market price per share. This all should be logically based on which profit? The reported profit. But institute unfortunately did this calculation on the PAT, which is future maintainable PAT. Institute asking you to calculate the market value, market price of the share, not on the PAT which was actually there, but on the PAT which will prevail in future. On that PAT, institute did all the calculation that from this PAT let me deduct the preference dividend, then divided by number of share to find EPS. Then multiply with the P ratio to find the market price per share. Right? The only ambiguity this question particularly has is this. Now you must be wondering, sir, how would we have to tackle the ambiguous question? As I said in the previous lecture, kind of remember it. The best I can do is that I can mark all those questions in pink so that you have to not worry about which one is ambiguous, so that your logic doesn't get disturbed, but you at the same time have realization of what is logical but what you have to unfortunately do in the exam. So I can say this particular chapter has a more ambiguous question than any other chapter. So don't worry that, sir, how would we be able to remember so many things in the entire course? This particular chapter has more such things. Didn't have an intent to solve it, just had an intent to explain it. 52 question. People, will you be able to please handle now at your own? Super ultra fast. Come on. Priyansh, this is not just the demo, Priyansh. Most of the students who are watching this lecture, plus those who will watch the recorded ones, have already purchased it. You can watch it in the form of demo, but this mostly is going to be the last demo. Maybe tomorrow we take it on the application. Priyansh? So this is a 4 lecture, the live lecture. If you want to take it as the actual one, you take it, or it may be demo for you. Aksa, Anuka, Dhananjay, all other live and recorded people. What's the status? 52 at your own now. 53. Question from study material was being asked, I think, I'm not sure, but was being asked in one of the recent exam, but is extremely typical. Given its probability of being asked, we should not cover this question. Rare nature of question, whatever you do in this question has to be first learned, will not be of use to any other question, so effort will not make sense. For 53rd question, belongs to study material, I'm being transparent, but given its rare nature, we are not doing. Yes? 53rd people, it's done. 54th and onwards questions, let me explain to you something which relates to Walter's model. The model which most of you would have done in CA interlevel. The reality of this model, everyone in the class, is that the formula is there in institute's material. There is this slight mismatch which has happened. So till the attempt of 2018, May 2018, Institute also had a topic called as dividend policy. That particular topic covers this topic of that particular chapter of dividend policy covered the topic of Walter's model. Institute removed that topic, moved it to CA Inter, but the Walter's model from the study material was not removed. The formula still remains in your study material, the latest study material. But if you look at the practical questions that a study material has, all the practical questions of Walter's model were being removed. If you look at the RTPs, MTPs exam papers of last 7 years, no question of Walter model was being asked. So what to do? Whether it makes sense to put in the efforts here? No, again we have to do smart. I will, on a lighter note, without explaining the logic of Walter model, explain to you that if we face a question, how do we solve it? So that if in case institute asks a question, because if the formula is there in the study material, it has all its right to ask, even if it has not in any of its publication in the last 7 years. Yes? Come on. People, you are saying this noise is not disturbing, is it? Give me a minute. Give me a minute. I need to shut the windows. Wait. Yes, people. Sorry for the delay. Walter's model. So now we realize that it has a mixed importance. There in the study material, my voice is clear? Yeah. Formula there in the study material, but no question in any publication for the last 7 years. What do? We put in the limited efforts. Sir, first of all, let's understand the formula. Walter's model, everyone in the class, make use of dividend as well as the earnings of the company. Walter's model say that we distribute dividend to the shareholder, that is his earning, plus some part of the earning we retain. For example, company earns 10 rupee. If 4 is distributed, then 10 minus 4, 6 is retained. E means earning, D means dividend. So E minus D is 6. 10 EPS, 4 dividend, 6 retained. This 4 rupee will go to the shareholder as it is in the form of cash. 6 rupee go to the shareholder in the form of cash as it is. Dividend. Right? How much did I take dividend? 4 or 6? 4. Sorry. This 4 rupee dividend will go to the shareholder in form of cash as it is. Rest of the 6 rupee which is retained by the company, right? On that retained earning, ROE, rate of return on equity, is multiplied and KE is divided. Sir, what is the logic? I would request you to not enter into logic. I can spend 15 minutes extra to explain the logic, has a very beautiful logic. In fact, in the regular batch, we also talk about what is the mistake in this problem. See. We talked about, I have written about it. It doesn't consider growth in its calculation as the shortcoming or limitation of this model. But all that discussion makes sense when you're studying AFM 2 years or a year before the exam. Right now, all these things won't matter to us. These particular things. No derivation would matter to us. What is needed for us is to application of the formula to the question, especially where it has a rare chance. So retained earnings multiplied by ROE or ROI, return on investment or return on equity, divided by cost of equity. Whole, this entire thing divided by cost of equity will give me the value of share as per Walter's model. Which means according to Walter's model, if you all pay attention, everyone in the class, listen carefully. Sir, 10 rupees is my EPS. If I distribute 4, retain 6, it will be different value. If I distribute 6, retain 4, it will be a different value. Which means my dividend policy, my payout ratio will affect the value of the share. That is what we should be aware of. Yes. So let's solve a particular question for your ease, for your comfort. And that particular question should be question number 55. 54 question homework you all need to do. in the notebook. Sir, why notebook? Because otherwise you won't write down the formula, you won't ever remember it. 54th homework by you all in the notebook. 55th we do it in the class right now. Alright, so let us proceed. Earnings of the company 10 lakh rupees, dividend payout ratio 60%, number of share outstanding 2 lakhs, rate of return on investment, even if they say ROI, it is ROE. I will have to assume that there was no debt in the company, it was all equities capital which was invested. Sir, equity capitalization rate is nothing but KE. Equity capitalization rate is KE. What would be the market value as per Walter's model? Sir, for Walter's model, first of all, I need EPS. Because from EPS, I'll have to first figure out DPS and then the retained earning. 10 lakhs earnings of the company divided by 2 lakhs will give me 5 rupee as my EPS, of which if I distribute 60%, which means I distribute 3. So dividend is 3. So retained earning is obviously 2. Retained earning multiplied by ROE divided by KE, sir, multiplied by 15 divided by 12, whole divided by 12%, which is 0.12. Do solve and find the value of the share as per Walter's model. Very important right now. Come on, do solve it. Give me the answer in the chat box. Sir, 2 into 0.15 divided by 0.12 plus 3 whole divided by 0.12 is 45.8333, which is 45.83 rupees as the value of share. ₹45.83 as per Walter's model, the value of share. Then another thing that Walter tells you is the optimal payout ratio. Right? Do you people agree? Please try to relate. If ROE is 15, KE is 12, then the overall value of the numerator will be more as compared to another situation where ROE is 12 and K is 15, because in that case you multiply this retained earning part, this part of retained earning, you multiply with a lower number, you divide by a higher number, so this overall numerator in the bracket become lower. Whereas out here this overall numerator in the bracket become higher because you multiply by 15 and divide by 12. What we mean to say is that we always want the value of share to be more and more. The concept of wealth maximization, agreed sir. So you always try to keep the value high. Sir, how can we keep the value high? By changing my dividend policy. For example, if I know that ROE is 15 and KE is 12, do you agree in that case, if 10 rupees my EPS, it's good if I retain 100% and distribute 0. Because if I retain 100%, which means entire 10 rupee, then 10 will be multiplied by 15 and divided by 12. Unlike that, if it is this situation here where 12 is ROE, K is 15, out of 10 rupee, if I retain 10, what will happen? 10 into 12 by 15 will be a further lower number. 10 into 12 divided by 15 will be 8. So numerator will reduce down to 8, which is not beneficial. What is beneficial? Sir, when 10 gets multiplied by 15 and divided by 12, 10 multiplied by 15 divided by 12 gives me 12.5 rather than 8. Meaning to say, you try to keep the payout ratio or the retention ratio. You try to decide that keeping KE and ROE in mind. Simple. I have not explained it to you logically, which is the actual method. Since we want to put in the limited efforts, I have explained to you using formula. Am I clear? So as per formula, if I talk about, the conclusion is really simple. If ROE is more than KE, then I retain as much as possible, which means I distribute 0% is the best thing. Whereas if ROE is less than KE, then the lesser I retain, better it is. The lesser I retain, better it is. Sir, I can distribute 100% is the best case. This is the actual conclusion. Sir, how is this conclusion? Depending upon the scenario here where we want to increase the value. We do this illustration we won't do it now, but because it doesn't make sense right now, but we try to figure out that for different level of ROE, KE is fixed. Here ROE is more than KE. Here ROE is less than KE. We try to figure out that, okay, by changing the payout ratio, how is my value getting affected? Observe it. If ROE is more than KE, if ROE is more than KE, it's good if the payout is 0. So in case of 0 payout value 960, in case of 100% payout value is 800, the value is reducing. But if you look at otherwise, when ROE is less than KE, then higher we distribute, more we distribute, higher is the value, less we distribute, lesser is the value. Yes. So let's apply the same logic out here. Sir, if ROE is more, KE is less, then my retention ratio should be 100%, payout ratio should be 0. So they are saying how much is the optimal payout ratio? We say the optimal payout is 0. And in that case, what will be the value of share? We pay 0. Entire 5 we retain. 5 into 12, 15 by 12, whole divided by 12 give me the value of share as 52.08. Right from 45, the value increased to 52. Value increased to 52. What inference would you draw? We draw that if the ROE is more than KE, then as the payout ratio decreases, the value of the share increases. When we retain more, when we pay less, the value of the share increases. That was question number 55. People in the class, done. Come on. Please tell me, are you all please settled, everyone? One thing I want to tell you, the batch that's getting recorded here will continue to be there at least for the next 8 months or 12 months. We generally try to have the live once in a year. We might sometime make it twice in a year. Depends. Now suppose you watch this lecture. Suppose I'm recording it here. After 6 months or 8 months, you purchase it. By then, there is a possibility that some books will get updated. For example, I might insert new question anywhere, so that might become question 56 rather than 55. On the screen you see it 55, but in your book it may become 56. Possibility 1. Possibility 2, I may remove some question, so on the screen it is right now 55, but in your book you may find it 54. Third thing which may happen is I might replace some question. For example, this is a particular question, 50. And I realized that in the attempt of Jan 26, Institute asked a better and refined version of this question. So I might replace this question with the newer question. So in that case, number might match or might not match, but the question itself you may find different. But there would be very less such modifications, rare nature. So please don't struggle. When you have a different question out here, it may happen, may not happen. In any of the questions, if you have a different question, please feel confident that you have the latest version of the book. Because when you purchase this lecture in May 26, I might update this question which was asked in Jan 26 in the outscanner and then give you the outscanner. Correct? So if that happens, please don't worry. Don't find yourself in the complicated situation. The reasons I have explained, that is only because of your betterment. Because certain question added, certain removed, certain updated. Having said that, you have the updated book. Refer that updated book so that you don't have to worry about that you are referring to something old. Now, lecture, you all might slightly different, but that doesn't mean the lectures are also outdated. They are older by an attempt or two, but that won't affect your learning. If 90% of 95% of the things you are referring to is updated, then for the 5% you can put in the efforts at your own. Even if you don't put in, I will come up with this video called as new question by ICI, which will have all those new questions covered. So don't struggle and feel that you're referring to something old. The book will be updated, the latest book, the lecture may be the one that I'm recording now. Right? Can't be happening a live batch every 4 months. Am I clear to all the students? So please don't find yourself that you are lacking anywhere. You are rather at a better position that you are referring to the updated book. Fine. Just wanted to give this clarification. Question number, which one gets done? Based on Walter's model, we have done this particular question 55. Now rest of the questions 56, you won't have to do. 57, you won't have to do. 58, you won't have to do. 59 onwards question we will have to do. So I think let us take a quick 5-7 minute break, post which we learn further concept of relative valuation, another easy method, and then do further question solving. People, are you all aligned to it? Shall we meet back? Shall we meet back at 11:25? Done? So let's meet back everyone at 11:25. A quick short 5-minute break, 5-7 minute break. So yes, everyone, when all of you are back, please let me know. People, are you all back, please? Everyone? So let's proceed now. Yes. So relative valuation, right? We have done discount based, dividend based, cash flow based, asset based, and earning based. In those four models of valuation, we took the help of some parameters which belonged to that company itself. For example, I want to value TCS, I need the dividend of TCS, or I need the assets of TCS, I need the cash flows or the earnings of TCS, not of any other company. But in case of relative valuation, we try to value our company relative to the value of other companies in the market. I will need the data of my company as well as the data of other companies in the market. That is relative valuation. The common sense is really simple. For example, I have three IT companies in the market. Three major companies have been TCS, Infosys, Wipro, right? Suppose their average PE ratio is 25 times. What is the interpretation of PE ratio? It is MPS divided by EPS. Interpretation means for every 1 rupee of earning that these three company earns, the price in the market that people are ready to pay for these companies is on an average 25. For every 1 rupee of earning, the price that is being paid is 25. Now suppose I am another third IT company, say Tech Mahindra, Techem. Suppose I am Techem, my EPS is rupees 60. So now you all tell me, for every 1 rupee of EPS, if people are ready to pay 25 rupee of MPS in my industry, then for my EPS of rupee 60, since my EPS is rupee 60, how much price people would be ready to pay for my share? Can you please feel the unitary that if one pencil is 25 rupee, then 60 pencil has how much? One apple is 25 rupee, 60 apples are how much? How much? Everyone? Sir, 60 into 25. Now this common sense become the formula of relative valuation. What is the formula? Sir, 25 is the ratio of industry or comparable firms which can be compared to my company. Sir, 50 is the financial parameter of my company, the company being valued. So financial parameter of my company, the company being valued, multiplied by the ratio is what will ratio of the industry will give me the value. That simple is the thing. The only thing that you need to now take care is that the parameter and ratio should be aligned to each other. For example, if the ratio is EPS, if the parameter is EPS of my company, then the ratio should be something which is based on EPS like PE ratio. What is the formula of PE, everyone? Sir, it is MPS divided by EPS. Now suppose the ratio to be used is price to book value ratio. What is the formula? Formula is MPS divided by book value per share. So the parameter to be used is book value per share. Common sense, right? If the ratio is based on book value, then my parameter should also be book value. Because what would this raise? The book value price to book value ratio is 10. It means for every 1 rupee of book value, if the price to book value ratio is 10, it means for every 1 rupee of book value, people are ready to pay 10 rupees of price in the industry. Then for my value of 150 rupee, for my book value of 150 rupee, how much will the people be ready to pay as price? That is the question needed to be answered. Yes. So the parameter and the ratio should be aligned. My EPS multiplied by industry's PE ratio will be my value. My book value share multiplied by industry's price to book value ratio will be my value. My sales multiplied by price to sales ratio will be my value. This is the equity value multiple based valuation. So this is the valuation based on equity value multiple or equity value ratio. The word multiple means ratio, equity value ratio. Very similarly, I have enterprise value based ratio. Enterprise value ratio based valuation. This time I am trying to value the company using not equity value but enterprise value. Sir, what is the difference between equity value and enterprise value? Equity value means the value that belongs only to equity. Enterprise value means the value that belongs to everyone. For example, in the numerator, I was taking price. Everywhere did you realize I was taking the price of only equity share in the market? But now the ratio I will use here will be enterprise value. Sir, what is the formula of calculating enterprise value? As I said, I want to calculate the market value. See, equity was the market value of only equity shares, price. Now I want to take the market value of all the capital provided, equity plus debt plus preference. What become the formula? People, it is market value of equity, which is nothing but the market cap of the company, plus the market value of debt, plus the market value of preference become the market value of all of them. One thing to specifically remember is you have to deduct cash and cash equivalents from it. Now, what is the logic? Unfortunately, again, we have a very limited questions given by the institute for it. Due to its limited scope, we don't enter into the detailing of when should the cash be deducted, when should it not be deducted. This is particularly a very interesting thing when I take a financial modeling sessions for the students who are appearing for job. To them I teach particularly when do you deduct cash and cash equivalent, when do you not deduct it. However, right now the institute doesn't touch to this level of depth. For him, there is a standard formula we have to follow. So enterprise value is how we calculate it. But sir, give us something so that we are able to remember it. So let me tell you what was the initial underlying logic of deducting cash and cash equivalent. When I acquire to you, enterprise value is the concept created for M&A transaction primarily. When I acquire you, I will have to pay you a price. To acquire your entire company, who all will I have to pay? I will have to pay your equity shareholder, I'll have to pay your debt shareholder, I'll have to pay your preference shareholder. All the capital providers I'll have to pay for the company to become entirely my company. Yes. This is the total cost I will have to incur. This is the total purchase consideration I will have to pay from my pocket to acquire your company. Correct, sir? Now what? When I acquire your company, this is the cost I am paying, the PC I am paying. Do you agree that your company will have some form of cash available with you? The bank balance available with you? So when I acquire your company, do you people agree that available cash or the available bank balance become that available cash or bank balance become my cash balance. So it is like basically I have paid this particular amount against which this much amount I immediately recovered by receiving the cash or bank back. Which is why with that logic of M&A, the terminology enterprise value has been created like this. That is not the entire story, that is the just part of the story I wanted to teach to you, so that you are able to remember that okay, cash and cash equivalents are to be deducted. So through it I could get the total value of all the total market value of all the capital providers. Sir, here I could get only the market value of equity. Now, sir, just like I had the ratios based on equity value, like price to earning ratio. Earning only belong to equity, price only belong to equity. Price to book value ratio. Book value only belong to equity share, price only belong to equity share. Now I will make use of those ratios whose numerator and denominator belong to everyone. Numerator will be enterprise value. Rather than equity value, it will now be the enterprise value, the value that belongs to everyone. Denominator will be again some financial parameter that belong to everyone. Out here I had earning in the denominator. What is the formula of P ratio? Sir, MPS divided by EPS. MPS belong to equity, EPS also belong to equity. Now my formula will be enterprise value to EBIT. Numerator will belong, enterprise belong to everyone. In fact, the earnings in the denominator also belong to everyone. I am not considering EPS in the denominator, I am rather considering EBIT. The earnings before interest and tax, the earning that belongs to debt, equity and everyone, if you realize. Are you? 1 second. The mic got disturbed. Yeah. People understanding, are you all? This particular thing, come on, tell me. Similarly, EV to EBIT ratio is the financial ratio, is the multiple that we have to use to value the company. So what is the ratio of the industry? In the industry, for every 1 rupee of EBIT which is being earned, how much enterprise value people are ready to pay? Suppose 6 lakh divided by 1 lakh is 6 times the ratio. For every 1 rupee of EBIT in the industry, people are ready to pay 6 rupee of price. Then for my EBIT of 10,000 rupee or 10,000 lakh rupee, how much people would be ready to pay price for my company? Are you understanding? So same thought process. Financial parameter EBIT of my company multiplied by the ratio which make uses of the same financial parameter like EV to EBIT ratio of 6 times. So 6 multiplied by 10,000 is 60,000. Logic remains simple. Financial parameter of company being valued multiplied by the EV ratio of the industry or comparable firms. EV to sales ratio. If the financial parameter you use is sales, then the ratio should also be based on that particular financial parameter, which means EV to sales ratio. EV belongs to all the capital providers, sales also belong to all the capital provider, because even the sales are being incurred. Even sales have been generated from the money raised from everyone, all the capital providers, right? Similarly, EV to capital employed. Out here we were taking price to book value. Price belong to equity, the book value belong to equity. Now enterprise value belong to everyone, and similarly the capital employed as per financial statement belonging to everyone. This is how it is. Please, people in the class, tell me. Yes. So that's how, using the financial parameter of the company that we want to value multiplied by the EV ratio, but the same ratio which is based on that particular financial parameter will give me enterprise value. From the enterprise value, if you deduct the market value of debt, if you deduct the market value of preference, look at this. If I have the enterprise value, can I reverse these three things? Can I bring them to LHS to find out the equity value? So deduct the market value of preference, deduct the market value of debt, and add the cash and cash equivalent to find the market value of equity. The same formula used otherwise. People, relative valuation, where you value the company using your parameter, and a ratio, either a equity value ratio or the enterprise value ratio, using the parameter of the company and the ratio of the market, I try to value the company. People, please respond. Are you clear with the concepts? Then I take you to the questions. Come on. Concepts, what is the status? Then I take you to the questions. Clear? So very immediately, let me take you all to the practical question. Sir, 59 extremely easy question, homework at your own, and that too only on the calculator. 60th is really a good question. I'll have to talk about it, but wait for it. 61 easy question at your own. 61 easy at your own. 62 only on calci. Wait. So 63 is a good question. 61 is also a good question. Wait. Sir, question number 63 if I talk about. Do you remember we had solved certain questions of earnings capitalization method, extraordinary gains, losses, launch of new product, profit and everything? 63rd is a question similar to that question we have already done in the class. 63rd is incorrectly placed in this category. You have to solve it at earnings capitalization method. Data also resembles as your own in homework. 63, the story same. If you want, you can solve it on the calci because the other two similar questions we have done in the notebook. 63, you may solve it only on calci. The story for 63 is clear. 62, time pass nature question. On a very lighter note, you have to solve it. 62 only on calci. 61, let us do in the class. Again, easy question, but we have some margin of looking at it in the class. Very fast, ultra fast. I will directly explain to you what the question is. I am this company called as XY Limited. I have book value, replacement cost, sales, net income. These are my parameters. When I compare my companies with other companies in the market, I find two comparable companies, SK and AS. Those companies have this market value, whereas the book value, replacement, sales and income of those companies are also given to me. Right? Fine. You have to use market to book value ratio, means price to book value ratio, to calculate the value of XY Limited. What is the common sense? Sir, common sense is really simple, that if I look at SK Limited, what is the ratio of this company? Book value to market value ratio. How much is the ratio? Sir, 450 divided by 400. 450 divided by 400, which is 1.125. For every 1 rupee of book value, people are ready to pay 1.25 rupees, 125 rupees as the market value for SK. Similarly, what about AS? Sir, 400 divided by 300 is equal to 1.33. For every 1 rupee of book value, people are ready to pay 1.33 in the market for AS Limited. Then how much is the average? You have to make the average of all your comparable companies so that you can find out an average value. So 1.33 plus, in fact I may take it till 3 digits because even this one is 3. 1.333 plus 1.125 divided by 2 is 1.229. Meaning to say, based on the competitors, the average of the competitors, comparable firms, for every 1 rupee of book value, people are paying in the market 1.229 rupees. Then if my book value is 250, then how much price people would be ready to pay for me? Logic is really simple. My parameter multiplied by the industry's ratio, which is based on the same parameter. My parameter is book value. The ratio, average ratio of the industry is also based on book value. I can use it. Sir, 250 multiplied by 1.229 will be my value, sir, which is 307.25, the value of XY using the parameter of book value, using the ratio of market to book value. People, on this particular thing, are you settled or not? Please respond. On this particular thing that we have done. Come on. Kindly everyone in the class, super fast. Super fast. People, please. Please, 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 everyone. Clear. Very similarly, this time they say make use of market to net income. In simple word, net income on a per share basis is EPS, market on a per share basis is MPS. So MPS divided by EPS is nothing but P ratio. But yeah, fine. Sir, SK for 18 rupee of net income, people are paying 450 of price. 450 divided by 18 is 25 times. For 16 rupee, people are paying 400. So 400 divided by 16 is also 25 times. So average is also 25. Yes. Which means in the industry, for every 1 rupee of income, people are ready to pay 25 rupee of price. So for my 14 rupee of income, how much price should the people be ready to pay for my share is 350 on totality basis. This is not per share, this is all totality. This is, so anyways, I mean, institute didn't specify it's per share or totality. You can continue with the numbers, right? So can I say that as per various parameters, as per book value being the parameter, my value is 307. As per income being the parameter, my value is 350. So on an average, how much is the value? The average of all the values, which is 363.43. Simply the average of all the values, which is 363.43. Are you all please aligned? Give me a second. Yes. So everyone, the 60th question is really a good question. It has a story actually. It has some ambiguity which was there in the study material. Then to an extent that ambiguity were rectified in May 24's MTP. Then again in the recent exam institute asked this question. I think in May 25 or something, we'll have to go through it again. And that's when the rectification was reversed. Something happened. So let me do that. Let me figure out those things and come back to you tomorrow with the conclusion. As of now that you see, this is that updated solution of May 24 MTP. But then I remember something happened in the very recent exam or MTP RTP. So let me do that. Let me figure it out, and then we solve this question in the manner which is needed. Yes. So this question will be pending from my side. 55, 59, as I said, extremely easy homework. 60 we do in the class tomorrow. 61 already done. 62 homework. 63 homework. Question 64, 65 and 66. All three question homework. And that too only on Cal. See, let me tell you what is the thing. Based on the concept of enterprise value, there are very limited questions. Very limited. So I had to incorporate in this book the illustrations from the study material. There were no questions. Now the illustrations are different from questions. In question, while framing a question, institute tries to ask you something. But while framing an illustration, institute doesn't try to ask you something, rather wants to explain to you something. So these three questions, 64, 65 and 66, you will have to go through at your own, not with an intent to solve it, but only with an intent to learn something. Which is why unfortunately the questions are bit ambiguous as well. For example, in 65th question, they use this word reserves and surplus. We clearly understand that reserves and surplus is in the liability side, cash and cash equivalent is the asset side. But that is the level with which they work, with which they think. These are obvious mistakes that they make. Rather than due to unavailability of cash and cash equivalent, they had deducted this reserves and surplus out here, which is completely illogical. I'm not even expecting such questions will be asked in the exam where you have to do such blunders. However, since we have an illustration in the study material, it's good that we just go through it. That's all I'm expecting. Don't take it very literally, sir, why this, why that. On a lighter note, just try to look at it, try to accept the rhythm of it, flow of it. 66th question can be done only after you have done the portfolio management, because this concept of levered, unlevered beta will be there in the portfolio management. So this you will be able to do only after portfolio management. Yes. Now in the attempt of September 25, there was this particular question asked on enterprise value calculation. I'll have to download it actually. So maybe that particular question also we take tomorrow. Fine. 60. So these two classwork questions will be there for tomorrow. 67th question, easy one, please listen to me. Do you remember we just solved a question where we say using book value, I have using my financial parameter of book value, I have the value. Using my sales, using my net income, I have some value. Similarly, we have next question where I have to value my company using different parameters. Using sales, I will value myself. Using my assets, I will value myself. Using my income, I will value myself. Right? But please realize this time my company has three divisions: wholesale, retail, general. So I will first value the wholesale segment using sales. Then I will also value my retail segment using sales, and I will value the general segment using sales. You have to please realize, if I have different businesses, can't I value each of my business separately and then add up all the values? Division A, this value, division B, this value, division C, this value. So why can't all these values be added up ultimately to find the total value of the company? So using sales as the parameter, I will find the total value of all divisions. Then using assets as the parameter, I will find the total value of the company, all three divisions. Then using income as the parameter of all three divisions, I will find the total value of the company. And the average value of the company will be average of all three. For example, using sales as the parameter, these three divisions has these three different value, total value being these. Asset as the parameter, these three divisions have these three value, total being these three. And that's how after I average out the total, I get the average value of my entire company, the average of all three value as per average of values calculated using three different parameters. 67th question, people in the class, could I explain? Please tell me. 67th, could I explain? So sometimes it makes sense not to skip a question if the efforts to be made to do that question are really less. Similar question we had done using different parameters valuing the same company. So what is the only point of learning in this question was, my company has three divisions. So I value three different divisions and then add the value of all those divisions to arrive at the value of the company. That simple was the thing, correct? Now the last question that we have to do is, please listen to me, what's going on. Now these two questions are pending from my side. Now we have the last segment of this chapter, which is other important topics, which has the topics like economic value added, market value added, rights issue, buyback, etc. Before we enter into the first topic of economic value added in this category, let me take you through some questions, other important topic. These are the questions which does not belong to any particular topic, but are random question asked by the institute which can best fit in this chapter, right? So let me take you to those questions. Basically there are only two questions. 68, that is something you may not do given its rare nature. 69th we all must do in the class. Yes? So let's proceed with the last question of the day. Can I have some energies to get started with this particular question 69? Everyone in the class, please tell me. Come on, come on, come on. Extremely logical question, really a good one. This question, if you look at the study material, belongs to chapter 1. Of study material, which is the chapter of financial policy and corporate strategy. You must be wondering, sir, what is this particular thing? So I am not good with drawing and like this. I don't know how to do it. So this is our way of writing and. All right. So let's proceed to the last lecture of the day. So come on. Krishna says, good morning. Good morning, Krishna. Where have you been since morning? It has actually become afternoon. You're just 2 minutes late now. Anuka, you will receive everything today because the lecture tomorrow mostly will be on the application. Stay updated to the Telegram channel. I'll have all the details shared there. I'll ask the team to give to you credentials today. Also ask them if they can make you people install and do the demo and everything today only. I'll figure it out with the team. If nothing happens in the worst case, we have the live lecture tomorrow on YouTube. No worries. You won't have to face any harm is my point. So, 69th question relates to the concept of external fund requirement. The underlying logic, please let me tell you, in these out notes, in the concepts notes, we don't have any such thing, this particular concept. So whatever you have to learn is to learn through this question. It's easy, not a great thing to learn. The underlying logic of this question is that as the company grows, as you expect your sales to grow, your profit to grow, your assets base will also have to grow. When you make a sale of 600 rupee, the asset requirement was 1400. Now when you sell for double the amount 1200, in proportion to that, asset requirement should also be 2800. Meaning to say, proportionate to the growth of my sales, my assets will also grow. Accordingly, my current liabilities will also grow because that is the part of my operation. To grow the sales, fixed assets have to be proportionately increased. With the increase in sales, inventory, debtor, cash will automatically increase. Creditor, loans, short-term loans will also increase. What will not increase naturally is this thing, because the money I will have to particularly raise from outsiders. Because for you to grow your asset, you need to invest in the fixed asset, you need to invest in your inventory, debtors everywhere. So to do that investment, you will need money. Where will the money come from? Come from either equity or the loan, either long term or short term. So this question particularly tries to explain, sir, how can you raise money? How much money is needed to be raised actually? When they say external fund requirement, let us try to understand this word. At CA inter level, everyone in the class, did you remember learning internal source of funding versus external? Internal are my retained earnings where I don't have to go to an external party like equity or debt to raise the money. It is my own generated profit. Plugging back was the word so far as I can recollect. Plugging back the profit. That is internal source. What this question tries to ask you is the external source. What you have to do is to do the proportions. That's all you have to do. Now let's read the question. I have share capital, reserve, long-term loans, short-term loans, payables and provisions. Then I have fixed asset, inventory, cash receivable, total being 1400. Sales for the year was 600, right? On 31st of March 2020, where the balance sheet has been given, the sales was 600. Sales are expected to grow by 20% during the year. Sir, I had the data of previous year. I had the balance sheet of this point. I had the balance sheet of sales of 600 rupees. Now, in the current year where I stand, they say the sale increase by 20% in the coming year in which I stand today. The sales are expected to grow by 20%. Profit margin, dividend payout are expected to be 4 and 50%. In the coming year where the sale will be grow by 20. Profit margin will be 4% of it, and of which 50% will be dividend distributed, which means rest of the 50% will be retained. Company further desire during the current year in which I stand, which will be with 20% sales growth, Sales to short-term payable and provision should be in the ratio of 4:3. What ratio have they given? Sales divided by short-term loans and payables and provision. This entire thing should be in the ratio of 4:3. Which means during the coming year, if sale become 600 plus 20% and I need to maintain the ratio of 4:3, how much should the payable provisions be? That I need to back calculate. How simple the question is, please try to connect, right? Similarly, they expect fixed asset to long-term loans should be 1.5. Now there is this hidden adjustment. You might think that the fixed assets is 700. No. With the increase in sales, this theory assumes everything will increase proportionately. The only question of this category in the entire course of external fund requirement, you will have to obviously, you will be able to automatically remember it. Sir, when sales increase by 20%, fixed assets also increase by 20%. So they say fixed asset to long-term loans is the ratio of 1.5:1. When fixed assets will be 600 plus 20%, the ratio should be this. How much should the long-term loans be? That also you can calculate. First, we need to tell me total external fund requirement. Then the breakup to be raised from short-term, long-term and equity. So very quickly, let's find out the fund requirement. Sir, right now, if I look at my capital employed, it is how much? People, let's look at this. 1400 rupee of assets invested. Payables provision of 200, that is the capital available through working capital. When my sales increase, automatically my assets increase, automatically my liability which relate to operation like creditors, provision, everything will increase. So 1200 is the net amount invested in the business. 1200 is invested. Sir, how is that invested 1200? Sir, please total up these amounts, you will realize that okay sir, 1200 invested. Agreed. If the sale increased by 20, the funds, the invested capital in the business, which is 1400 minus 200, will also increase by 20%. Same proportion, right? So 1200 plus 20% is additional amount of 240 to be required. Make sense? At every step I'll ask for your validation. Are you people please settle till this point? Kindly respond. I'll ask for your validation at every point. Come on people. Please tell me. If you are settled till here, I'll immediately take you to the next one. Come on. Yes. The main point of understanding was, you can think it otherwise as well. Sir, what if my asset increased by 20%? It'll be 1400 plus 20%. What if accordingly payable provision increased by 20%? It'll be this. So net capital requirement will be how much? Sir, 1400 plus 20% M plus 200 plus 20% M minus, memory recollect is 1440 will be the net capital invested in the coming year. Whereas previously it was 1200 as I could observe, which means the requirement of additional capital for the next year is 240, which is the same number that we have done using common sense. Agreed. Out of this requirement of 240, is this entirely the external fund requirement? No. With the coming year end, I will need to have 240 additional capital, but how much of it is internally generated? Let's figure it out. Sir, for the coming year, sales will be how much? 600 plus 20%, which means by the end of this year, sale will be 720. Of which 4% will be margin multiplied by 4%, 28.8 will be the profit. Of which 50% will be retained, which means 14.4 lakhs, everything is in lakhs, 14.4 lakhs will be, everyone in the class, the amount to be retained, which means that is internally generated. So by the coming year end, if I have 240 as my additional fund requirement, 14.4 will be generated internally. So how much is to be raised externally? Sir, minus 240 from 14.4 is 225.6 to be externally required. Easy. Think first part of the question gets solved. Second part. Now in the second part, they are saying how much is to be raised from short term, long term and equity. What is to be raised from short term? What is to be raised from short term? Sir, raise such that the ratio of sales of 720 divided by short term loans plus payables and provision should be 4:3. Through this calculation, how much should the sales, short term loan, payable, provision be? Sir, 720 multiplied by 3 divided by 4 should be 540. Should this number be for the next year? From which payables and provision will become how much? 200, which is right now the payable provision. Sir, plus 20% will be 240 to be the payable provision next year. So out of 540, if I eliminated the expected payable provision for the coming year, this current year, how much become the expected loan? 300. Short term loan should be 300 by the end of this year, which is already 300, which means can I raise anything in the form of short term loan? The answer is no. I have tried to present this solution in a more cleaner way, neater way than institute. Clearly used the word expected, etc., etc. Similarly, coming fixed assets are going to be 720. They say that the ratio should not be more than 1.5, should be 1.5. So accordingly, long-term loans can be, according to the calculation, 480. Right now, long-term loans are 400. How much can the additionally be raised through long-term loans? 80. So out of overall fund requirement of 225.6, to be raised from short-term loan 0, to be raised from long-term loan 80, which means rest of it entirely to be raised by way of equity, everyone in the class. Rest of it is to be entirely raised from the equity. Are you please, people in the class, understanding it? Come on, tell me. 69th question. Done in the class, extremely easy. What is the level of your comfort on this particular question? Question number 69 out of 10. Everyone. Waiting for your responses. Come on, Aksa 10. Come on, all other live and recorded people in the class, is it all 10? Such an easy but different question, right? This particularly gets done. So tomorrow mostly will be the last lecture for this particular topic of equity and business valuation, where we complete rest of the things, right? Overall, so far, when you all have come here, how is your learning experience? All the live people, all the recorded people, I would really request you to respond to it. Recorded people, through the comment section, not of this video, but the first lecture. Please go to first live lecture. Take this extra effort, go to first live lecture. Comment in that video what has been your literal feedback. It really motivates me to do such things. It really helps newer students to figure out if the lecture is actually worthful or not. If it is not worthful, you may write that down, it's okay. But write down your comments. Live people, will you please do it once for me? Come on. Go to YouTube channel, go to live section where you will find these lectures, or best in the description of this video I'll insert the link of lecture 1 and 2. There you write down the comments. Done. So that is great, everyone. Thank you so much for joining in. you will receive most of the things today, the books and everything, hopefully. All right. Thank you so much people for joining in. I'll see you again. Bye bye. Take care. Thank you everyone. See you all. Take care. Stay connected to the Telegram. Bye people.